welcome to my YouTube channel, The Accounting Educator. I'm Safir Ahmed, a senior lecturer in accounting and finance in a UK university. I also work with ACCA as an early career ambassador. This video is relevant if you are studying financial accounting, preparing financial statements for your AAT level 3. In this video, I will be covering AAT Practice Assessment 1, Task 4. Okay, so this task is about producing financial statements for sole traders and partnerships. So in process of producing the financial statements, there are certain items which go as part of your statement of profit or loss, and other items go into your statement of financial position. And depending whether the business is a partnership as a sole trader, so there are some subtle differences. Okay, so it has two parts, part A and B, but again, these part A and B have multiple parts, subparts. So the first one is identify whether each transaction would lead to an increase in owner's capital. Now we know that what increases owner's capital if there is a capital injection or if there is a profit for the year. So we add these things in the initial capital. But in terms of drawings will decrease the capital rather than increasing it because we deduct it. So there will be no increase in capital for drawings. Similarly, a loss for the period, a loss for the accounting period, we deduct it, it decreases the capital rather than increases it. So if it was profit, it's different because profit increases it. And an injection of capital by the owner, we already talked about this. I mentioned this, that of course that this will increase the owner's capital. Okay. The owner's putting his laptop into the business. So remember, investment of owners into the business is capital, so it will increase capital. That investment does not have to be in the form of money. It could be any personal item owner is bringing into the business. Okay, the next part of this is identify whether the following statements about statements of financial position for partnerships are true and false. So the first one is a credit balance on a partner's current account means that the partner has drawn out more than his or her share of profits. Now that's false because credit balance means that the person has this much more than what they have taken it out. So this is kind of positive balance in that sense. So this will be false. The finance by section of the partnership statement of financial position include balances of the partner's capital accounts and current accounts, and that's true, we know that. For a sole trader, remember, is normally opening capital plus profit minus drawings. But for a partnership financial statement of financial position, we just record the partner's current balances and also partner's capital balances. In other words, that their current accounts are temporary accounts just for this year, and their capital accounts are their permanent accounts in that sense. So of course this is true. Okay, so the next part of this is we've been given a trial balance for a partnership, and what we've been asked to do is to prepare a statement of profit or loss. And then, of course, in addition to that, we've been asked to prepare a profit and loss appropriation account. Okay, so we will need all of this or some of this information, of course, which is relevant. So sales revenue, we know that minus cost of sales gives us gross profit. And we know that the way we calculate cost of sales is opening inventory And the opening inventory is given to you here. So as you can see, opening inventory value is 9290. Okay, and of course we add purchases in it. And again, purchases value is given to us. So the purchases value is 213290. And then what we deduct is closing inventory, of course. So the closing inventory is here, and the amount for that is there, as you can see, which is 7710. And this will give us the cost of sales figure. So the cost of sales figure is 9290 plus 213290 minus 7710. And that has given us 214870. And of course, sales minus cost of sales gives us gross profit. So basically, sales revenue minus this amount, and that has given you 1438210. And what we need to do is we add other income. So from these items, the only other income item is discount received here. So we will be adding discount received amount, and the discount received amount is 570. And less expenses. So what we need to do is we need to identify expenses, indirect expenses. In other words, now one of them I can clearly see is the depreciation. Depreciation charges, and depreciation charges are 92,590. And if you look at expenses, the other expenses, I mean, one of them is other expenses with the name, and we need to look at that if there is any other expenses as well. Okay. So we recorded the depreciation charges, but as you know, irrecoverable debt is an expense as well. And the irrecoverable debt amount is 1390. And of course, then we have other expenses as well. And the amount of other expenses is 1267597. 1267597. And that has given you the total expenses. So all we need to do is gross profit plus other income minus expenses, and it will give us the profit for the year. So 1438210 plus 570 minus 1361577, and which has given me 77203. Okay, so we have completed the statement of profit and loss, and now we will be preparing the profit and loss appropriation account. Okay. Profit for the year. So this is your profit, the one you calculated in the first part, 77,203. And then what we add back is the interest on drawing. So interest on drawings is given to you here. So as you can see, for the first partner is 141, and for the second partner is 41. And then what we'll be deducting any other appropriation of profit, that the profit that partners have taken out of the business, perhaps in the form of interest on capital or perhaps as a salary. So interest on capital, again, those amounts are given to you here, so which is 10,525, and again 10,525 for the other partner. And then in terms of the salaries, partner salaries, now you can see that Imran works within the business and is entitled to a salary of 25,000. Nancy is not entitled to a salary. So only one person is entitled to salary, which is 25,000. Sorry. I don't know why I recorded it there, but remember the partner salaries is here. 25,000 for per first partner, of course. And this will automatically go as part of the total as well. As you can see that Nancy is not entitled to any salary. So this will give us the profit available for distribution. So in other words, 77,203 plus 182 minus these two amounts. So let's have a look at how much it is. So which gives you basically 31,335. Now this will be distributed between the partners, and they're given you in the ratio of 60-40. So that means that 60% to Imran and 40% to Nancy. So which is 31,335 times by 60%, which gives you 18,801. And if you take 40% of the profit available for distribution, and the amount that gives you is 12,534. So we have distributed a total of 31,335. Now, what else can be tested as part of the partnership financial statements? They can test partners' current accounts. And what you need to remember about partners' current accounts, drawings and interest on drawings go on the debit side. And then everything else goes on the credit side, or loss obviously goes on the debit side as well if the company has made, if the partnership has made any loss. But other than that, the profit share is going to go on the debit side. They can also ask you to prepare capital accounts, the permanent accounts. And again, remember, if there is a permanent change in partnership, that every time there is a permanent change in partnership, we'll be creating goodwill and we will be eliminating goodwill as well. And that, of course, goes on the partner's capital accounts, or they could ask you to prepare a goodwill account as well. So please be mindful about that. They can also ask you to prepare a statement of financial position. In this question, they didn't ask that. Of course, that's another important financial statement that can come up in exam, whether it is for sole trader or partnership business. Okay, so thank you for listening. I will be back with other videos. Okay, now the final part of this task is some of the adjustments that we need to make. So opening inventory, as you know, that it only goes as part of your statement of profit and loss, as part of your cost of sales, basically opening inventory plus purchases, remember. So it will be debit side of the statement of profit and loss. That's 22,650. And then the closing inventory, again, closing inventory, remember that where it goes. So it goes on the debit side of the statement of financial position, which is 25,420. And then it also goes on the credit side of the statement of profit and loss. Remember, opening inventory plus purchases minus closing inventory. So in other words, on the credit side of the statement of profit and loss. 25, 4, 20. Okay. And then we have loss on disposal of non-current assets. And we know that loss on disposal of non-current asset is an expense. And therefore, it will be on the debit side of the statement of profit and loss. So that's 200 there. And what we need to do here is that we need to calculate whether it is profit or loss, depending on amount. So it looks like it's profit. As you can see, the difference between these two. So credit side of the statement of profit and loss, which is 189,695, minus, of course, the debit side, which is 162,505, which gives you, of course, 27,190. And remember that this profit is added in your capital, which means that it will be on the credit side of the statement of financial position. So which is 27,190. Okay, so as you can see, the over extended trial balance is balanced, which is a verification that your answer is 100% correct in this part of the question. Okay, so I hope that this was helpful. So please watch out for the other tasks as well, as I will be making more videos on the remaining tasks of the financial accounting practice assessment 1 as well as practice assessment 2. Thank you for watching. It's not a game.